Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? Well, it's something that all of you are addicted to watching, right? Well, I call this your daily dose of velocity banking crack. And I don't know if you knew this or not, but we have over 57.9 thousand hours of watch time on this channel. 57,000. If you don't know, if you've never done the math, let's just kind of quickly do the math. 57,000 divide by 24 hours, that's 2,300 and something days, right? And then divide by 365, and that's 6.5 years. 6.5 years of people watching this content. And let's go ahead and make that number go up a little bit more with doing more of the velocity banking stuff and feeding your addiction. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of a line of credit. Okay. And so, if you know anything about debt, banks love to lend to people who don't need money, right? So, if you're making a good income like this, their hope is they'll offer you debt debt offers like personal loans, credit cards in the mail. Hey, why don't you just get a new auto loan? You qualify. You should go back to school. Go get a student loan. Although this one is a little bit different because it's guaranteed by the student. I'm sorry, by the federal government. Mortgage. Oh man, they love lending to rich people for mortgages because they're very risk averse, especially after the 2008 crash. But the thing that we have to understand is that banks don't lend money to people who need it. So there was once upon a time where we made good money and we didn't have any debt. We didn't have any debt, right? And so the bank sees this because, if you know anything about credit reporting and banking, they share your information. Newsflash, they'll offer you a credit card in the mail or a credit card offer in the mail, an auto loan, a student loan, a mortgage, right? So eventually you kind of get sucked out, and next thing you know, even though you have an insanely good income, you're calling like the Dave Ramsey shows, like, I'm broke, right? Dave Ramsey has tons of callers where it's like, I make over 300,000 a year and I'm broke, right? And why are we broke? Because every extra payment that we have from debt essentially eats up our cash flow. And so the whole point of the strategy is to pay off our debt without making more money and just simply redirecting the flow of money. Okay. So let me go ahead and do this. I'm going to go ahead and copy and paste. Right. And as you can see here on the expense breakdown, we list every single debt that we have. And then in this last line item, we just put our general expenses together. That's not debt, food, gas, insurance. Okay. Etc. I can't even think, what do I spend money on anything else? Maybe some video games. I don't know. Okay. Now, here's the thing that makes most people feel uncomfortable, that they're not going to save any money throughout the entirety of the process, right? So if you take a look at my savings account, okay, I don't save money. Like, what do I need to save money for? No need to save money, right? So was money, as soon as money comes in, right? So I'm going to show you this, right, where the paycheck comes in, whatever you get paid, it goes in. It's actually this, right? Let me just actually do this. It goes into your checking account, and then it goes to the line of credit, and then expenses, right? They come out of your line of credit. So your checking account isn't your main operating account anymore. It's your line of credit. Okay, so when your paycheck comes in, it gets dumped into the line of credit. When your expenses comes out, it comes out of the line of credit. Okay, very important. And we also need a thing called the line of credit. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. And then you see here, this is my $280,000 home equity line of credit, right? $280,000. And so again, with this line of credit, I can just click a button on the bank's website and they'll dump up to $280,000 at a 7.5% interest rate, right? And every bank is a little bit different. I had one line of credit where I can only get $10,000 a day max dumped into my checking account. But this line of credit, I asked, like, are there any limits? They're like, nope. And I'm like, all right, sweet. All right, so that's basically my line of credit, and I think this was me at the closing table when I signed for it, but I may be wrong about that. And this is my mortgage that I paid off in 2 years and 9 months. Blah 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 blah. So let's skip that for now. And Here's what we're going to try to do. We're going to increase our cash flow with our line of credit. Okay. We're going to increase our cash flow. And let's go ahead. Oh man, I got to do a wrapping around this. Well, actually, it is wrapped. All right, never mind. Okay. All right, let's do this. Okay. So, how are we going to increase our cash flow? By moving some of the debt into the line of credit. And let's start off with the credit cards. How much a credit card debt do we have? 25, 26, 50. And then I'm going to do this right here. And then this is going to be 101,101,000. And then as soon as we move that debt, guess what happens to these payments? Oh my goodness, this goes to zero. This goes to zero. This goes to zero. And we literally went from negative 60 cents. Let me dramatically zoom up to $3,387.73 without making more money. You see how the income is the same, but by simply redirecting our flow of money and making our line of credit as our main operating account, that's what we do, right? And so now it's the final step of the process, well, semi-final, is you dump your entire pay in, you take your expenses out, and then you pay, yeah, what's it called? Your cash flow is going to be the amount that your debt reduces by. So it's essentially your debt, the amount your debt gets destroyed with some interest. So minus 3387.73. So to get the next month's balance, you just add these two up and minus your cash flow. And then what we're going to do is we're going to take the average daily balance, multiply it by the interest rate, and then divide by 12, right? So I'm going to go ahead and copy and paste this. Copy and paste, and then you see, whoa, how did I get paid off so fast? I don't know, but that's relatively quick, right? And so when we were worried about credit card debt, nothing to worry about. And remember, we didn't have anything left over. In fact, when we're at this point, the bank's making money from their overdraft fees. Okay. But here in this situation, because we're still paying our bills and we're not late, we don't have any overdraft fees. Is that cool? All right, so let's go ahead and do this. So this is going to be 34 months. 34 months, right? 34 months. And how much did we pay off? 101K. All right, I'm going to do this. All right, so now we got 1, 2, 3, 4, four debts, four loans, okay? And then we just have a lucky loan calculator right here. Okay. So if you want to understand like how we pay off these debts, the easiest way to help figure it out is not just by looking at the interest rate, even though this does affect the amount of interest you pay. We want to focus on the cash flow. Much easier, right? Much easier. And we have this thing called the cash flow index system. It's a concept I think invented by Garrett Gunderson, where it just says, hey, take the statement balance divided by the monthly payment. It's going to give you a number, right? And think of this as a ranking system. And the lower the number, when you pay it off, you get more cash flow, right? So for example, if I pay off this 9 grand, I get $386 of cash flow. But if I pay 130, I only get 900. Heck, if I pay 328, which is almost 3 times, I'm only going to get 1400. And that's what this higher number means. It's like, don't pay this off one yet, pay it off later, because there's going to be such little cash flow for focusing on this one. So let's go ahead and take these low numbers, right? Take these. I'm going to go ahead and sum it up. And then this is going to be 27 grand into the line of credit, right? Into the line of credit. So this is going to be plus 27687.86. And then, okay, and then this is going to be these two. We get an extra $1,000 in our cash flow, and our cash flow is 4 grand. We're good times here, right? So let me go ahead and do this, and we're going to replace our cash flow 4493.3.23, and I'm going to do this, and we'll see that we pay it off in about 40 months. 40 months, okay? And so only 6 months to pay off 2 auto loans, not bad, right? Aren't you addicted to this content? Because you probably have friends and family who are probably in this position, and they're like, only if there were a way to pay off this debt quickly without making more money, right? If only there were a way. You know what's funny? I react to a lot of like Instagram or no, not even Instagram, TikTok content, and they're like, I'm in $20,000, $30,000 of debt, but I'm only making minimum payments. It's like, well, you're the best candidate for this thing that we go over. I wonder if there's a system where you dump your entire paycheck rather than the minimum. Right. All right. So let's go ahead and do this. And so the next one is the student loan. So student loan. So this is going to be 0, 0. And how many months were we at? 40 months. Okay. So 40, 40. All right. So one of the things that we have to kind of be a little bit considerate of is that do we want to move the whole thing into an entire line of credit? And it depends, right? So if you have a very low cash flow index, interest rate is a little, the effect of it is pretty minimal, right? But if you have a high cash flow index and you have the interest rate of the loan is pretty much similar to the line of credit, then it's much safer to move it into a line of credit. And since this is a 7% loan, I feel comfortable moving into an 8% line of credit, which is fine. I mean, we might be losing a little bit of money there, but I'll do it for now because I'm a little bit lazy. So let's go ahead and do that and move this 130 grand. Okay. And only get $898 of cash flow, right? So let's go ahead and pay it off. Okay. And let's do that right here and control. Plus 130.030.87 and minus 5391.39. Okay, I'm going to copy and paste, and then let's see how long it takes us to pay off that student loan as a lawyer. And so, I don't know, what are we, a lawyer or a doctor? Probably a lawyer. I feel like a doctor student loan will be in like the 200K range, 67 months. Now, if I'm really smart, I'll just create a Velocity Banking for Doctors or Lawyers channel, and then they'll all pay me. All right, 167 months. All right, so now what's 162 plus 135? That's almost 300K. And then now at 67 months, let's figure out where we're at. Okay, so it took us 17 months to pay off that student loan, which is about a year and 5 months. And then now, okay, we have this mortgage at $306,000. Now, a lot of people complain like, well, 3% isn't realistic these days, but you have to understand there's a ton of people with 3% mortgages, right? So again, don't be so self-centered and know what's current in the marketplace right now. So that's why people are dumb. They only think about now rather than like, hey, what's going on with everybody and what are the vast majority of mortgages out there in the market? They're at 3%. Okay. So let's go ahead and do this. And I'm going to type this in this Velocity Banking calculator. What's the current balance? 306,251 point, what was it? 71.71. And then what's our income? Our income is much higher, so this should get paid off relatively quickly. 9367. 9367, and we'll just do what we call a $10,000 chunk. So what's the whole point of this exercise? I'm going to show you two things, right? If there's a huge interest rate difference and you don't get a lot of cash flow, right? So this huge cash flow index number, you're going to be paying a lot more than you should. So if I do this, right, you see how this is paid off in 4.3 years and 56 grand of interest. But if I just do this in small chunks, 10000, 19 grand and 3.8 years. So I know there's a lot of people who say, oh, first lien HELOC, first lien HELOC. For most people out there, it doesn't make sense. I'm going to tell you that. And I've had people emailing me like, should I do a first lien HELOC? Like, you're the only person out there on the internet saying like it's a dumpster fire. And I'm like, well, I don't give financial advice. But if you've seen the demonstrations and just kind of going even here, right? Like, oh, a first lien HELOC is this, right? Versus this. you'll end up paying a lot more interest than for the most part. Most people will end up paying a lot more interest. So it's 3.8 years, and I'm going to do this. So 3.8 plus 67 divided by 12. So we paid off everything in 9.38 years, debt free. Woo! Maybe we can increase our spending a little bit and still buy $6,000 and not be, we'll be okay, you know? And that's the beauty of the strategy, right? Like you don't have to do exact budgeting. You just throw all your money into the line of credit and then rinse and repeat over and over again, and you're debt free. And take a look at me. I am the goat of debt payoff, right? The goat to the greatest of all time. And I paid off my mortgage in 2 years and 9 months. Now, I'm not saying that's typical. I'm just saying that's me, right? So, because I'm the greatest of all time, I typed in ChatGPT, like, hey, ChatGPT, I paid off my mortgage in 2 years and 9 months. What percentage of people does that put me? And ChatGPT is like 1%, top 1%. So remember, like Occupy Wall Street, like we're the 99%, and that was such a long time ago when banks crashed the economy. But it's like we're the 99%. Well, according to ChatGPT, I'm top one, so I'm unrelatable, right? So all right. So actually, before we end this off, let me see if I could get a picture generated of velocity banking crack, because that's the theme of this video. So give me one moment. All right, there we go. According to the Meta AI, this is a person addicted to velocity banking crack. Meta AI. I don't even know what this is, but apparently it's the velocity banking crack because you're all addicted, right? All right, well, that's it for today, folks. This is Crane Atlanta mentorship. We're going to be at 5,000, no, 4,000 subs soon. So might have a live stream just to kind of celebrate. I don't know. Or just hang out. Or even if we don't reach 4,000, I might just do a live stream just to hang out. All right. Have a great day, folks, and I'll see you all in the next video.